Accounting is the language of business, and investing requires a fluency in it. Hello and welcome back to Exploring Finance with Prashant. I am thrilled to have you here as we continue our exciting journey in the world of financial shenanigans. In the previous episode, we discussed about two techniques used by the management to boost revenue. Before we go on with today's episode, I would like to appreciate your patience and understanding. My episode length varies from one episode to another because it depends on topic to topic. As a beginner, I am working on improving the consistency in the episode duration. I truly appreciate having such a wonderful audience. Let's get on with today's episode. Just as dancers whirl and swap partners, companies navigate accounting process where costs and expenditures are carefully managed through distinct stages. We will delve into the tempo of this financial dance, how companies can influence it, and why diligent investors should pay attention to the steps management take to impact the earnings. There are mainly four techniques or rather steps of this financial dance to deceive the investors that is used by the management and told and found by Howard Schillett and his partners. Let's discuss each one in detail. Let's go to the first technique, that is excessively capitalizing the normal operating expenses. Before we delve into this technique, let's talk about some basic accounting. There are mainly two types of assets. First are the ones which are expected to produce a future benefit, such as the fixed assets. These assets are actually close cousins of expenses because they represent the cost which we have incurred to grow a business. The second ones are those that are ultimately expected to be exchanged for another asset, such as cash, like investments. Now let's dive into the examples. One striking real life example comes from telecommunications giant WorldCom during the dot-com era. As the company's revenue growth began to slow, it faced mounting pressure from investors to meet Wall Street's expectations. In response, WorldCom restored to a simple yet deceptive tactic. Instead of reporting certain line costs as expenses, it capitalized them as assets on the balance sheet. Wait, what are line costs? Well, line costs are generally the cost a customer pays or a business pays to access and use something owned by another business or entity, which is crucial for its operations. They vary from industry to industry. For example, a telecom company may pay fees to access another carrier's network to connect long distance phone calls or to route internet traffic. These costs are a fundamental part of operating a telecommunications business as they enable the company to provide services to its customers by connecting them to the other parts of the network. Now let's get back to WorldCom. The accounting maneuver of WorldCom, amounting to billions of dollars, created the illusion of lower expenses and higher profits, ultimately concealing the deteriorating financial health of the company. Now, as diligent investors, how will you look for this improper act of changing the nature of operating expenses? Now, here are a few plays to be looked at that are told by Howard Schillett. First is unwarranted improvement in profit margins and a large jump in certain assets. Second, a big unexpected decline in free cash flow with an equally sizable increase in the cash flow from operations. Third, unexpected increase in capital expenditures that belie the company's original guidance and market conditions. Another example under this technique can be of checking whether the companies have adopted any change in the accounting policies and if there is any boost in the revenue because of that adoption. For example, Lucent Technologies, which is now part of Alcatel, that is a French telecommunications company, obtained a nice earnings boost by starting to capitalize internal use software costs mandated by a new accounting rule. Later, the merged company was bought by Nokia in 2016. There are a lot of other examples that can be discussed, but the most important ones I have discussed. One more in Indian context I would like to discuss the example of Syntex Brilliant. In the period leading to its bankruptcy and investigation for fraud, Syntex Brilliant, a company in the tech industry, raised eyebrows for adding peculiar new items called tooling and inventory deposits to its balance sheet. These mysterious entries, supposedly representing deposits with their primary supplier, Colin, were both unusually large and rapidly increasing. What made it even more suspicious was that Colin, the supplier, had significant ties to Syntex Brilliant, being a major supplier and having a major stake in the company. These developments raised serious doubts among investors, highlighting the importance of caution under unusual asset accounts, especially with related parties, suddenly surge in the financial reports. So, what lesson did we learn from this technique 1? Before I go to the lessons, I just need to make a correction that when I say a major stake, I means a high stake, not in majority by 51%. I'm not talking about that. Now let's move on to the lessons. First, we saw the case of WorldCom, in which we learned for being aware of sudden boost in the operating profit, and the reason could also be that the nature of the certain expenses is manipulated by the management. The second, we learned that regardless of the legitimacy of an accounting change, investors should strive to understand the impact that this change had on earnings growth. Third, we learned that a new or unusual asset account in the balance sheet, particularly the one that is increasing rapidly, may be a sign of improper capitalization. Now, let's get on to this technique, or you can say the step number 2, along with a few real life examples. Let's first discuss an accounting basic again. The nature of a cost and the timing of its related benefit dictate the length of time that this cost will remain on the balance sheet. For instance, imagine a restaurant that purchases fresh ingredients. The money spent on these ingredients remain as an asset on the balance sheet until the restaurant uses them to prepare meals and generate revenue by selling those dishes. Now let's consider a construction company that invests in heavy machinery for its projects. The cost of these machines doesn't immediately become an expense. Instead, they are listed as assets on the balance sheet. Over time, as the machinery gets used and wear down, their value is gradually expensed through depreciation, reflecting the long-term benefit they provide to the company's operations. This is the base of the technique number 2. Now let's discuss some examples. Turning inventory into an expense is usually straightforward when a sale happens. It becomes cost of goods sold. But in industries like aerospace, it gets a bit tricky. Take the Lockheed's TriStar L1011 program as an example. They used a method called program accounting where they assigned an average cost per plane even if the actual production costs were higher. They hoped to offset these excess costs with later more profitable sales. However, this approach backfired when the incremental cost consistently exceeded the incremental revenue. Today, program accounting continues in the aviation industry as seen with the Boeing Dreamliner program, which faced its own share of challenges. This story highlights the complexities of amortizing inventory cost in certain industries and the importance of careful financial management even in the skies. A company that chooses an overly long depreciation or amortization period generally would be considered guilty of using aggressive accounting. A more serious offense, however, is companies changing the depreciation for a longer period. This often suggests that the company's business may be in trouble and that it feels compelled to change the accounting assumptions to camouflage deterioration. Example can be of Intel, which changed the revised schedule of a manufacturing equipment in 2015. It may have done this with a good rationale, but do mind. Healthy and confident companies are far less likely to tinker with these type of accounting assumptions that only provide optical benefits. Before we go on to step 3, what did we learn from this step? First, we learned that inventory cost should be looked for carefully if sufficient data is available. Second, we learned that we should look for the amount of income gain from the changes in depreciation lives because in case of Intel, it did improve its gross margin at a time when it was facing a lot of pressure from Wall Street. Now it's time to learn technique or step number 3 along with a few real life examples. Failing to recognize an expense for costs that were correctly capitalized but lost the value before the expected benefit materialized. This third dimension of financial caution reminds us of the critical importance of timely and accurate expense recognition, avoiding the traps that can hinder financial transparency and integrity. Let's discuss the first example. In the world of accounting and finance, it is not enough for companies to stick to a rigid schedule for depreciating their fixed assets and assume that nothing will change. Instead, the management should regularly assess these assets for potential impairment, and when the expected future benefits drop below the asset's book value, they must take action. Imagine a piece of equipment initially estimated to last for 10 years, but it unexpectedly breaks down in fifth year of service. In this case, the original depreciation plan should be abandoned and the remaining value should be immediately expensed. If the company continues to depreciate it over the original 10-year schedule, it fails to recognize that the asset's value has been impaired. Often, companies that announce significant restructuring charges are attempting to rectify their failure to write off the impaired cost correctly in the earlier periods as part of their efforts to clean house financially. So, what did we learn from this technique? We should look that impaired plants should not be a part of PPE. Obsolete inventory should not be a part of inventory. If it's there, that means that the company is trying to inflate the profits. Few companies have clients who consistently pay all their bills promptly or maintain investments that never decline in value. Most companies encounter occasional deadbeat clients and underperforming investments. Even renowned investors like Warren Buffett have their own share of setbacks. When these situations arise, companies can't simply hope for the best. Accounting rules mandate the regular write down of certain assets to their net realizable value. Accounting receivables are, for example, should be adjusted each period to account for likely bad debts by recording an estimated expense, that is, provision for doubtful debts. Lenders must also recognize an expense or loan loss each quarter to accommodate expected defaulting borrowers. Additionally, investments facing permanent decline in value must be written down, reflecting an impairment expense. Failing to make these adjustments results in overstated profits, highlighting the importance of accurate financial reporting and responsible asset management. Let's discuss a few examples. Vitesse Semiconductor chose to record only $1.9 million in bad debt expense despite incurring $14.3 million in the prior year. By further reducing an expense for estimated sale returns, Vitesse ended up accruing just $2.2 million in estimated expense during 2003, comparing to $49.9 million in such expense in 2002. If Vitesse had accrued these expenses at a same percentage of revenue as previous year, its operating income would have been approximately $50 million lower. Unsurprisingly, a board investigation in 2006 uncovered numerous accounting issues, many of which were related to improper accounting for revenue and receivables. Second example is of New Century Financial, the first subprime mortgage company to collapse during the financial crisis. In late 2006, despite rising delinquencies and increasing bad loans, New Century shockingly reduced its allowance for loan losses. Management even obscured the presentation of the loan loss reserve in its earnings release. Had the company maintained its release at a similar percentage of non-accrual loans as in the previous quarter, earnings per share in September 2006 would have been plummeted or reduced by 58%. Investors who closely monitored New Century's loan loss reserve had an early warning of the company's impending downfall, which ultimately led to bankruptcy and legal actions against senior management for misleading investors during the company's collapse. This illustrates the critical importance of accurately assessing, and reserving for credit losses in the financial industry. One more notable example under this technique comes from Japanese camera maker Olympus. It began with the company making risky investments in 1980s and early 1990s, which were initially properly reflected on the balance sheet at their original cost. However, as the investments deteriorated in value, Olympus failed to recognize the impairments. Ultimately, management resorted to concealing these losses through fraudulent schemes, such as Tobashi schemes, where they transferred money losing investments off the company's books to hide the losses from investors. The term Tobashi is Japanese, which translates to flying away, symbolizing the practice of making losses vanish or fly away by making them to another by moving them to another entity. So what did we learn from this technique? When all reserve accruals are moving in the wrong direction, which means they are decreasing instead of increasing, it is a red flag and it's time for caution. Second, the loan loss reserve decline relative to bad non-accrual or non-performing loans. That is also a signal that you should be cautious. We should always look for impaired investments in the balance sheet. That's all for today's episode. I do hope it was informative and interesting for you. Let me tell you all the key takeaways from this episode. First, vigilant scrutiny. Vigilantly scrutinizing financial statements, especially when the data is available, Pay close attention to inventory cost, potential change in depreciation methods as they can reveal important insights. Second, income gains and depreciation. Keep an eye on income gains resulting from changes in depreciation methods, especially during challenging periods. This can offer valuable cues about a company's financial strategies under pressure. Third, recognize impaired investments. Always be on the lookout for impaired investments on the balance sheet. Failure to recognize these can lead to misleading financial reporting and impact the investors negatively. Fourth, reserve accrual trends. Watch for the trend in the reserve accruals. When reserves are consistently decreasing instead of increasing, it's a red flag that demands caution. Always remember, with dedication and the right guidance, anyone can enhance their investment acumen and make informed decisions to secure their financial future. Thanks for listening to this episode. In the next episode, we shall discuss more techniques used by the management for manipulating expenses to inflate their profits. Until then, keep questioning, keep learning, and keep exploring the captivating world of finance. Thank you. Have a nice day.